The next financial crisis will not look like the last one, but it will hit harder. Not because people are worse, but because the system is more extreme. Bigger markets, faster money, more hidden risk. This is not stability. This is fragility disguised as progress. The modern financial system is often described as advanced and sophisticated. In reality, it is overloaded. Too much debt, too much leverage, too much interconnection. What used to be small, contained problems are now global threats. And when this system breaks, it breaks everywhere at once. There are no isolated markets anymore. Banks lend across borders. Investment funds operate globally. Pensions, insurance companies, and governments are tied into the same financial web. A default in one country does not stay in that country. It travels through balance sheets, currencies, and markets worldwide. This is why modern crises spread so fast. There is no buffer. There is no safe distance. Finance now moves faster than human control. Trading is automated. Capital flows react instantly. Confidence can disappear in hours. In the past, bank runs took days. Now they take minutes. Depositors do not queue outside branches. They tap screens. Regulators cannot pause this process. They can only react after damage has already occurred. Speed no longer protects the system. It destabilizes it. Most financial risk today is invisible. It lives in derivatives and shadow banking. Derivatives were meant to reduce risk. Instead, they multiplied it. They link institutions together through complex contracts that few people fully understand. Shadow banks borrow like banks but avoid bank-level regulation. They rely on confidence, leverage, and constant liquidity. When confidence breaks, these structures collapse instantly. This is not theory. This is exactly what happened in 2008. The system did not fail where people were looking. It failed where people were not. The system now depends on central banks to survive. Markets expect rescue. Banks expect support. Governments expect funding. Interest rates and money creation are no longer emergency tools. They are permanent life support. This creates moral hazard. Risk increases because failure is no longer allowed. But central banks cannot solve structural problems. They cannot create real growth. They cannot print stability. Each intervention delays collapse but increases future damage. Too big to fail is no longer about individual banks. It is about the entire system. Major institutions are so large and interconnected that letting them fail would destabilize whole economies, so losses are absorbed by the public. Through inflation, through debt, through reduced purchasing power, profits remain private. Risk is socialized. This is not an accident. It is how the system is designed to survive. We have already seen the stress. In 2008, one market froze global finance. Credit stopped. Trade slowed. Millions lost jobs. Supply chain failures caused global inflation. Not because demand exploded, but because the system had no slack. Recent banking stress showed how quickly confidence disappears when trust is questioned. These were not rare events, they were stress tests, and the system barely passed. The modern financial system is not resilient. It is stretched, leveraged, and dependent on constant intervention. There are no firewalls left, no clean failures, no contained collapses. When the next crisis arrives, it will move fast and spread wide. Understanding this is not optional anymore, because those who understand the system prepare, and those who do not pay the price.